Let me ask you something. What if the world's safest asset isn't a government bond? I mean, what if the entire concept of risk-free, the very bedrock of modern finance, is just wrong?
Think about it. We're all taught the 10-year U.S. Treasury is the gold standard of safety. But is it? It gets eaten alive by inflation and is completely tied to the fate of one single government. Now put that next to a business like Visa. Inflation, that's a tailwind for them. And they're not tied to one country. They're diversified across 200. So it really makes you stop and ask, what is risk, really?
Well, today we're going to explore a powerful framework from the Averaging Up collection called the permanent wave. And the core idea here is really profound. It argues that a very select group of businesses are not only safer than government bonds, but that they are also systematically structurally mispriced. And why? Because the very tools we use in finance are actually built to misunderstand them.
Okay, so how does this work? The whole framework starts by breaking down any business into two fundamental forces. You can think of them as operating on two different timelines. There's the toll, and then there's the wave.
So let's start with the toll. This is the simple stuff. It's the cash a business collects today, right now. The perfect example is Visa. Every time you tap your card, they take a tiny fraction of a cent. That's the toll. It's that immediate present-day cash flow, and it's usually protected by a really strong competitive moat.
And then you have the wave. Now, this is all about the future. It's the growth a business is going to collect tomorrow that it's not getting today. This is the long-duration value, all that cash flow that's still on its way.
Now, this is a crucial distinction. The framework splits growth into two types. On one hand, you have mechanical growth. This is what most companies do. They have to spend billions of dollars. They have to execute flawlessly. Think of Amazon building out its warehouses. It's incredibly expensive and risky. But then there's natural growth. This is growth that just arrives. It costs the company nothing. It's delivered by huge structural trends. Visa is the classic case. They don't spend a dime convincing people to use digital payments. You know who does? Governments, banks, and consumers. The growth is delivered to their doorstep for free.
And that mechanical path? It's just loaded with risk. There's a concept called non-ergodicity, which basically means one single bad decision can wipe you out permanently. You don't get a do-over. And if you want to see what that looks like in the real world, look no further than Kraft Heinz. They had a catastrophic $15 billion write-down. All that value, just gone. Destroyed forever by human error.
Okay, so we have the toll, we have the wave. So how do these pieces come together to form a truly exceptional business? This is where it gets really interesting. When you combine a permanent, stable toll with a free, natural wave of growth, you get something the framework calls an A paramount. And the key here is that the effect isn't just A plus B. No, it's A times B. It's multiplicative. That free growth comes in, drives revenue, that revenue funds things like buybacks, and the whole cycle just restarts, but from a higher and higher base each time.
Now you might be wondering how many of these businesses exist. Well, this structure is incredibly rare. In fact, the analysis concludes there are only 5 of them on the entire planet: Visa, MasterCard, S&P Global, Moody's, and MSCI. And what do they all have in common? They each sit right in the middle of a massive, powerful, long-term secular trend. So here's where we get to the core of the argument. This unique business structure completely flips our normal understanding of financial risk on its head. Let's go back to that 10-year Treasury. We call it risk-free, but that's just a convention. It's not reality. In the real world, it's loaded with risk. You've got inflation risk, which just silently destroys your purchasing power. You've got reinvestment risk. What do you do with those coupon payments every 6 months? That's a new decision, a new risk. You have sovereign risk, because you're betting on a single government. And of course, you have duration risk. If rates go up, the value of your bond goes down. Simple as that.
This is the great inversion. An A paramount business isn't just immune to these risks, it actually benefits from them. Inflation? Like we said, it's a tailwind for a company like Visa, because prices go up. Reinvestment risk? There is none. The growth is automatic. It just happens. And that sovereign risk? Forget about it. You're diversified across 200 countries, which is just structurally safer than any single government's promise.
When you look at it from this kind of physics-based perspective, the conclusion is just inescapable. The world is upside down. And A paramount is, by its very architecture, safer than the asset we call risk-free.
Okay, so the obvious question is, if these businesses are so much safer, why aren't they valued that way? Why isn't everyone piling in?
And the answer is fascinating. It's because this complete inversion of risk literally breaks the tools we all use for valuation. Let's think about how you'd value the toll part of the business. You know, the part with cash flows that are as certain as a Treasury coupon. We can use a simple Buffett-style approach here. You just take the free cash flow per share and multiply it by about 20, which is basically the inverse of a 5% risk-free rate. That gives you a pretty solid valuation for just the toll.
All right, let's run the numbers for Visa so you can see exactly how this works. Their free cash flow per share is about $19.39. You take that, you multiply it by 20, and you get a fair value for the toll component of around $388, just for the toll.
Now here's the punchline. At a recent market price of about $299, what are investors actually paying for? They're paying only for that stable, predictable, present-day toll. Which means the entire multi-decade wave of global digitalization, that massive, permanent engine of growth, you're getting it for free. Absolutely free.
And the reason this incredible mispricing can even exist is because our standard financial models, the discounted cash flow spreadsheets we all learn, they are built on one fundamental assumption. High growth has to mean high risk. You can't have one without the other. But an A paramount just shatters that assumption. It creates a paradox that the spreadsheet literally cannot process. You have extremely low risk combined with high free growth. The two variables come apart and the model just breaks. It can't handle it. So, this isn't just some one-time margin of safety opportunity. This systemic failure in valuation actually creates a permanent compounding engine. And the framework has a name for it, the latent margin of expansion.
And here's how this engine works. It's a perpetual cycle. Step 1. The market, because of its broken models, undervalues the asset. Step 2. That free wave of growth keeps rolling in, pushing earnings higher. Step 3. The stock price has to partially correct upwards to reflect those new earnings. But, and this is the magic part, Step 4. The valuation gap, that latent margin, immediately reforms at this new higher price. It's ready to start the whole cycle all over again, driving the next wave of compounding.
When you boil it all down, the entire thesis comes down to one powerful idea. This kind of asset doesn't need the market to ever price it correctly to deliver incredible returns. It simply compounds in the gap between what it is and what the spreadsheet says it is.
To explore these investment strategies further and discover more from the collection, visit the website averagingup.com.